Hello, good afternoon. Hey, this is Rick Leimbach with Startup Portal. Another another seminar on equity crowdfunding. Sorry about the pause there. Um, here to talk to you about raising capital via debt. Yeah, sorry about that. I have a little echo that we'll have to take out. So there we go. Um, okay, let's see here. We can mute that. So today's topic with equity crowdfunding is working through and talking about debt. Oh man. Let's see here. Let's try, pardon me. Let's try this again. All right. Hopefully I fixed our technical issue. My name is Rick Leimbach. Not. Let's just try to do it. All right, here we go. This should work now. All right. Okay, let's get to that. Sorry, folks. I apologize for the delay here. We've got some technical issues that we're trying to figure out. So, there we go. Hopefully people are sticking with me here, so my apologies. Nope. All right. All right. Okay. Sometimes you can only prepare so much. All right. We'll start over here. So, And my name's Rick Leimbach. After 5 minutes of technical difficulties, we're going to start talking about equity crowdfunding and using debt for equity crowdfunding. So that is our topic today. So if I could go and essentially start sharing our slide, you'll see that our perspective is to give the viewer an understanding of debt as a vehicle for equity crowdfunding. So we're going to get into it and talk about different facets of equity crowdfunding and how we use it to raise capital. And you ever have to do like 10 takes? Okay. There we go. Once again, we're here to talk about equity crowdfunding. My name is Rick Leimbach with Startup Portal. And essentially our topic today is talk about using debt for equity crowdfunding as a vehicle to go out and borrow money in a couple different forms, but to borrow money to allow you to execute your plan. So if you have a restaurant, if you have a company that is generating revenue, and you go to the bank or you already have a bank facility and you need something to really help you to get there, there may be ways that equity crowdfunding, essentially could help you in that regard. So with that said, I'm going to jump into our deck and sort of walk you through the different vehicles of equity crowdfunding that are available to utilize. So fix some of our notes here ourselves. Yes, so with that said, we'll go through and go to our next slide. If you look at an opportunity to invest in a company and get your money back, and someone says to you, I'll give you basically 1.75 of every dollar you give me and give that back to you, and they say, we're going to pay you back as we generate revenue today. And then they say, hey, the faster we generate revenue, the sooner you get paid back. So if you do the math and you look at their model, there may be an opportunity to start getting your money back in very short order, but also by the time you're fully paid, have a decent return on your revenue and cut down on your risk, essentially your revenue risk as you get paid back, or I'm sorry, you're really return on capital risk. So there's an opportunity there for companies, and this one's pretty aggressive. We'll see their example later on, but it really shows that they need the funds, and they're willing to have a decent exchange to get those funds. So with that said, equity crowdfunding is geared around the non-traditional way or a new way to raise capital. The traditional way was to go to a bank, sit down with the banker, present your business plan. The banker will then really, as I've been told, really take it upon themselves to put their reputation at risk, to go to the committee to approve your loan. So they really want to dig in and make sure you have a good plan in place. And you really have to deliver and have all the numbers and everything together. With equity crowdfunding, using equity crowdfunding as a bank, you're in some regard doing the same thing. You're putting your information out there for potential investors to look at. However, it's spread, and the risk is spread around not just one banker or one loan committee, but the crowd itself. So they can invest in smaller chunks and help you get to where you need to go. Now, I will say, as we look at the examples, that we're going to talk about, equity crowdfunding and using it is not the most inexpensive, way to borrow money, without a doubt. It has to fit your purpose. You have to have the ability to get the capital back, but it's not the most, basically effective way. Your traditional bank really would be the best way to raise capital. And typically they're going to have better rates, and they're going to have, essentially they're going to want more collateral, let's say. Alternatively, before we get to the next area. When you're looking at, some of the online fintech companies, buyer beware as far as borrowing from them, even if it's $30,000, $40,000, $50,000, because they will ask you to start paying back on a weekly basis. And what that does is put pressure on you to make sure you can deliver on a weekly basis versus, whether it's a bank or equity crowdfunding on a monthly basis or potentially quarterly basis. Has a big impact on your business if you're not careful. So with that said, there are different options, and debt is used in different ways of raising capital for small businesses. The banking, the friends and family, private equity. You can do private equity with debt. Usually it's, that little more expensive, or it comes with a quirk to it, like warrants or options, and other types of vehicles get very expensive. And usually there's a cutoff to say, hey, pay us back this. So you could do a loan for a year, but guess what? At 12 months period of time, boom, you're going to need to get paid back. Equity crowdfunding, it was designed to be favorable to, essentially the crowd, to let them have the opportunities to see decent returns, but also to the potential borrower in terms of debt, to make sure they potentially have a vehicle outside the traditional ways of raising capital, because there's a risk element to it. So the crowd's willing to put in a smaller portion of their money, probably for a higher risk, where the bank can put in a lot of money, but they want very low risk. So it's a balancing act, and there's all kinds of vehicles to do this, no doubt about it. Now, equity crowdfunding is not common to small town America. It's coming. It's a vehicle that's used in typically cities, technology-based companies, but there are companies, breweries, restaurants, software, all facets of businesses are utilizing equity crowdfunding, and many of them are using it, as we'll see from a few examples, for the defined purposes that they need. So just saying I'm going to open a restaurant, or I'm going to start a company, I'm going to raise capital, you're better off on a Kickstarter, which is people giving you money, and not expecting a return on it. Here are people wanting their money back. Now, let's talk our first example. Balavanera is based in New York City, and essentially it's an Argentinian restaurant. The plan for them to build out the restaurant is about $1.1 million, and they've already have a bank loan. So what they needed and what they successfully raised was $124,000. And they got it from 63 investors at a 10.75% interest rate. But they needed those funds to get them operational. The 60% for additional equipment, and another 40% for what's called working capital. And if you're opening a restaurant, in the working capital, they define it as opening cost. Really, you're going to have that window of time where you open the doors, you hire staff, you train staff, but you're not generating, full capacity or a large percentage of revenue day one. You're usually opening, getting your systems together and bringing in the crowd over time. So really, the working capital helps you, and also it helps you manage, essentially you're putting out for inventory, getting revenue back and refurbishing the inventory, et cetera. Now, one of the things in this regard is that there is a lien on the assets. This is coming through a portal by the name of Honeycomb, which really specializes in a lot of food-based type companies that allow you to, essentially piggyback on another loan. In this case, they have a blanket lien on the assets, which is essentially a second lien. The primary lien is whoever is the bank in front of them, which may actually be investors or something of that nature. Now, over to the right, you'll see a little chart, and it just talks about the return. So you're putting in $10,000 here. Hypothetically, if you do, your return over a 5-year period is going to be $13,194. They're going to start making payments either in 3 or 6 months and then pay through, and it's a loan over a 5-year period of time. So if you have confidence or want to support a company like this, you can certainly make a higher return than a traditional CD, of course. And the nice thing with loans is you're the bank, so you're starting to get your money back pretty quickly. So that's example number one. Example number two is the hottest thing out there. pickleball. So these folks in Massachusetts want to put together a facility with 10 pickleball courts. And they have high hopes. They're looking to raise 75,000 to I think 125,000 to allow them to basically, as you can see from the right-hand side, build the courts, put the netting in, upgrades to the building, and obviously the portals themselves, and this one is Mainvest, they actually have a certain percentage of fee that they will take in essentially helping you raise the capital. So in this case, it's a revenue share. And you can go to their debt revenue agreement in their documents. If you go to Mainvest and track down Pickleball City, you'll see that they say it's a revenue share note. They're going to give you back essentially for every dollar, 1.4 back on your return. And they have high hopes of generating $5 million in revenue on this facility and raising the capital to do so. Now, this is where you have to really do your own homework to say, okay, pickleball's hot. Are there other companies that have done pickleball that have done crowdfunding? And do a comparison just to see, is this in line? Can they really do it? Get to the point where they can raise capital, and they're successful to raise 65K. But can they get to that revenue level where they're paying me back as we start, where we started, as fast as they can by generating revenue? Now, look into these guys. Evidently, pickleball is a lot of fun. There's 38 days left for you to potentially invest in this company. So do your research. You can see on the Mainvest website, the different elements. Obviously, we're summarizing all the activity, but the website will provide details of the management, who the company are, their background, their experience. And I think their experience here is in the golf industry. So it's a complementary aspect to have management that understands the service element of a sport. So all good stuff. And it looks like if they're 38 days left, they've raised 65, their goal is 75, they're going to hit it. But again, this is another way of looking at raising capital, utilizing debt. In this case, it's that revenue share note. So our next example is a company out of Old Fort, North Carolina, Kitsbo Apparel. And these folks have raised 600K to date, and they have 357 investors. This one is pretty aggressive with that return. This is their example of our first discussion of they'll return 1.75 to your investment. And they're already forecasting 22% growth. They did 2.6 million in revenue in 21. The numbers for 22 obviously aren't out yet, but they've been in business 10 years, so they know how to generate revenue. Their product is essentially outdoor apparel. So if you go to the Kitsbo website, you'll see some quality outdoor apparel based in the North Carolina mountains, and certainly I'm sure they'd love you to look at potential investment, but also look at their product as well. So purpose is key when you're utilizing any vehicle to raise capital. And here you can see one of their statements saying we are not profitable. So they're admitting to they need funding. We need between 1.5 and 2 million to reach profitability in late 23. So of which 1 million is the goal for this raise. So this raise, another 400K, will help them get to their, basically give them that runway and that purpose to raise capital, to keep the operations going and build up that revenue stream that going into 2024, they're self-sufficient, generating cash flow from the business and essentially paying the investors back at 1.75%, 1.75 for what they've invested. The interesting thing here is that once you get to the point that you pay that back, you're free and clear. It's unlike equity where you have a partner for life, where you have stock ownership. Here you've paid it off, you got it done, and don't get me wrong, 1.75 million over a 5-year period of time might be a heavy lift for these folks, because I think the percentage revenue may be like 0.7%. But all in all, it's a balancing act of high return and basically the risk element of, okay, is that enough to get them there? Now, the beauty is, let's say they need to go out and get another loan, or they need to bring in equity for investors. Well, as a potential investor here, getting 1.75% of revenue back, my biggest concern is that they keep in business and keep generating revenue so they can pay my loan back. So selfishly, from an investor standpoint, you're going to start getting your loan back sooner than later. So you can really find yourself, basically reducing that risk over, every quarter that they pay out. I think it's quarterly. So check them out. But another good example of how equity crowdfunding, has different flavors of ice cream when you're looking at it, and really could fit your business model to help you raise the capital. And vice versa, if you're an investor, just to look at these companies, do your due diligence, try to compare to others to allow you to see, does this make sense for me? And quite frankly, especially with the a portal itself, the requirement sometimes is only $100. So if you have a passion for the company, you want to see them successful, maybe an opportunity to put a few dollars in and see if they can generate that return and pay your funds back and follow them over time and potentially reach out and buy their products or use their products. So there are 3 examples of equity crowdfunding. I'll show you from the schedule, which is probably hard to read, but we look at all the different equity crowdfunding deals that are out there and try to give you a comparison. In this case today, you'll see over to the right, the big square in the middle, it is all debt. So we pulled down all debt deals and pulled a sample of those to discuss today. But really, when we're doing this, we're drilling down to see, does it fit your business model, and trying to find examples that may provide you the opportunity to understand, hey, this, I think I can raise capital with this at the appropriate level, but also put myself in a position that I can afford to pay it back. And when you're done, you're looking at essentially just you. So that's that's the piece that I like. Pardon me one second. That's the piece that I like in allowing that to be utilized in equity crowdfunding. So with that said, we'll So one thing at the left here, if you're watching this and you're like, hey, I'd like to see a certain industry, feel free to send us an email. Rick at Startup Portal or info@startupportal.com, and we'll gladly send you this sheet so you can actually drill down on the filing and the SEC website to help you prepare and understand, essentially equity crowdfunding. So we'll go to the next slide. Startup Portal itself, essentially, we have 2 locations. We are an outsourced financial services company that specializes in helping startups with financial planning, modeling, helping you with the business plan. We typically don't write your business plan. And obviously we talked about equity crowdfunding. So feel free to reach out, if you have any questions, comments, etc. I'm glad to speak to you. And then obviously, please follow us on the social media, and we'll have other events, other activities that can help educate and provide that balance between investors